Good afternoon, everyone. This is Brian Shannon from Alphatrends.net. Let's take a look at this market here. For the week, we were kind of mixed. The Russell 2000 was down the worst amongst the equity indexes, down 2.8%. You can see the semiconductors were down a half of a percent. And those are two groups that we've been looking at as far as the Russell in particular that has been holding above support at 81. We'll see that shortly. That was broken, though. And that kind of puts us a little bit more cautious going forward. You can see that these markets are slowing down a little bit. They've had a hell of a rally here. You look at this S&P 500, still up on the week and obviously month and year to date. But this market has been holding above that rising 10 and 20-day moving average, and it's just kind of turned a little bit more neutral in here. Early next week, I think the more important level for us to be watching is about 136.75. That's going to kind of be our near-term line in the sand that if we break below 136.75, then we want to get a little bit more cautious. We can see that we're still kind of riding this trend line. Let's just redraw it in there. If we take a look, we've just had this incredible uptrend, and we're still riding that trend line. And the more times a trend line is tested, the more likely it is to fail to continue to hold. But as we've seen with the Russell 2000, what we've been talking about in there for a while, it doesn't it mean an immediate shift in trend. In fact, what am I looking for here? Let's just back that up a little bit. Here's what I was looking for: is that we broke that uptrend line in the Russell 2000 a couple weeks ago, and then have turned sideways for another couple weeks in that 81 to 83 range that we've been talking about. We bounced off of it 2 days ago, so we got down Wednesday afternoon. Thursday we rallied up and hit that declining 5-day moving average, and it was lower from there. And now in the Russell, we have to look at that 81 level as the near-term level of resistance, that the intermediate term trend is guilty till proven innocent until we at least get back above there. However, with the Russell, we're still in an uptrend on a daily time frame. So we don't have that alignment of trends. We have a longer term uptrend, and perhaps we're going to find some support down near this 50-day moving average, which is, let's just not draw it in, but take a look. It's about 78.80. So we could still see a little bit further bleeding in this Russell 2000. And if that market is now leading the rest of the market, then we have to be a little bit more aware that the market seems to be kind of stalling out, getting a little bit tired in here. We were still up on the for the week, but this is the 5-day volume weighted average price for the S&P 500. You can see we were basically neutral in relation to what was the average price that the SPY traded at this week. We closed right on it. So that tells us that maybe this is time for a little bit of a pause, perhaps a little bit of a pullback. But again, 136.75 is the level we want to keep an eye on early next week. Otherwise, you can't get aggressively short on this market while we're still holding above key levels of support. And that's not even a key level of support. That's a near-term important level. But if that breaks, then I think you're going to see a quick move down towards at least that 136 level. And the next level below that would be closer to 134 to 134 and a half in that area. So we're a little bit extended still, but not breaking down. The buyers remain in control of the trend of the Nasdaq. Obviously, we've closed, I don't know how many consecutive days, but every day since we broke above it back here in late December, we've closed above this rising 10-day moving average, and we've gotten up to today's high was 65.08. We've been talking about the 65 level for several weeks, couple months actually, that this is an area of focus where there might be a little bit of a battle between the buyers and sellers. It doesn't mean this level is not can't be penetrated, impermeable. I don't know, but excuse me, this is maybe where we're going to see a little bit of a pause, a pullback, and then the market regroups and gains its strength. It remains in a fantastic uptrend. That's obvious here. If we take a look at that 65-minute time frame, we've still got this trend line intact, and that's again where a 10-day moving average also comes into play. Looking at key levels for next week, I think about 64 to 20 is our first bigger level that we need to be aware of. That's the prior resistance acting as support. And then below that, just above the 63 level, has been a number that's been contested here a little bit recently, and then down probably 62.70 or so. So these are the levels that, if we begin to break down, where we would look for the potential of support. The market could completely fall apart. That's not the normal type of action in here, but breaking these support levels signals to us not that we necessarily want to get short. I don't think there's anything wrong with that for aggressive short-term traders, but it signals us that perhaps the easy money or the easier money of this trend has been made, and it's time to move to the sidelines and become a little bit more cautious. Because again, the breaking of the trend line in the Russell didn't do anything to change the trend of the market. It did signal a slowdown in the uptrend that eventually turned into distribution. Now we know its distribution only because it broke down. If it broke beyond 83, then we would have said it was accumulation within that range. And that may sound like, well, what's the value of that? The value of that is knowing that we're in an important range and that it could go either way. And as I spoke about, typically the break will occur in the direction of the primary trend, which is higher. Markets don't do everything that's typical. Typically, your kids will behave. They won't go to college and take their shirts off and go on Girls Gone Wild. That's not what you typically want to happen, but it could happen. And fortunately, I don't have daughters, so I can use that example. But the point is, nothing is going to act as you expect or you want it to, which is why we have to be aware of these key levels and aware of the appropriate reaction when the market moves in either one of those directions. In this case, the Russell is breaking down below that 81 level. That's resistance until proven otherwise, and that puts us on caution until this market can say, hey, it's straightening itself out. Perhaps again it heads down to the 50-day moving average. That's also where we see this trend line that comes up off of the October lows from last year. The semiconductors have been kind of a little bit choppy in here lately. We do have a lower high in these, but we've been holding above that important 34 level. That's the level we've been focused on, and correctly so, or correctly, maybe correctly. I don't even know. I'm not speaking well today. But I'm not getting points for my grammar. 34 is a key level. If we break below that and hold below it for more than a half hour, like we did in the Russell 2000 below 81, then I think you want to look at these semiconductors and say it's likely due for a little bit deeper pullback, and perhaps the 50-day moving average would be the first level that we would expect it to encounter. That a battle, and then down towards these prior highs, and then this longer-term trend line if shit really hit the fan. But I don't think that's going to happen. But again, it's a possible scenario. The fact is, when the market does this, it tells you can't be aggressively long. That's the key takeaway. Not okay, well, we'll see what happens. Well, we do have to see what happens, because the primary trends, or the intermediate term trends that we've been enjoying here since the beginning of the year, are showing signs that they're slowing down and breaking down in the Russell 2000, slowing down in the semiconductors. Financials uptrend are still intact. We've still got that key level that we're holding above this prior bigger support down near 1460, and perhaps we're still headed up towards 15 and a half. But with other markets breaking down, we have to be aware, what is the message of this market? That is the message of financials. We broke above a key level this week and actually closed above it at about $14.70. So I'm sorry, $14.80. Just below that, though, we do have 1470 as an important level. So if we break down, we'll see if that holds. If it doesn't hold, I would expect a move down towards the bottom end of this range at 1470. And if 1470 were to fail, then we have to think about the possibility of a deeper pullback, perhaps down towards the 50-day moving average at $14 a share, and this prior level in here. So the key takeaway for the markets this week is, we're getting stocks that are extended to the upside, and people keep calling for a top. If you remember 2 weeks ago, how many people were saying that's it? Look at the big volume. That's the end of Apple. It never closed below that day's close right there. Instead, we've been continuing to push higher. at the beginning of the week, people were calling this a double top. Well, that's no more a double top than this was a double top, or this was a double top, or this was a double top. You don't know till after the fact. And when you look at Apple, for instance, still above its rising 5, 10, 20-day moving average, it's still in a very powerful uptrend. It doesn't mean it can't reverse quickly, and that there aren't stocks that are getting hit hard in this market. You look at Hewlett Packard, which was at a new high 2 weeks ago, and since earnings came out, it's now down on the year, and just continued relentless selling in shares of Hewlett Packard. You look at other names like NIHD. Here's another stock that's just continued relentless selling. So we're getting more of a two-sided market, but I still think that. We're starting to see the easier upside movements are becoming a little less common each day, and there's less stocks that are rallying. So, what I meant to talk about today as well was this RENN. Someone had asked me, and I was talking about it, for a while. But talking about the big short position in here. And yesterday I tweeted that above $5.60, I would be nervous if I was a short seller. And someone asked me today, well, wouldn't you have sold after buying above 560? Well, first I was involved yesterday, not at 560, but on this little break here, and added to it at this point. I had taken some profits out, and I did not adhere to my discipline yesterday on this stock. I thought it closed weak. I was kind of kicking myself because I was holding some stock and I held it overnight. I didn't think it was a good decision to hold overnight. And basically, I came in this morning and got lucky. I don't, and as I was saying in the chat room, I kind of felt dirty for making money in a situation where it wasn't what I normally do, or doesn't agree with the way I look at the market. I did get lucky here. I don't like to rely on luck. I'd rather that it closed strong and then gapped higher. Then I would have felt better about it, and I could have congratulated myself a little bit more. The money's still going to spend the same. That's not the point. But I know that I had a sloppy trade here, and it's good to make money. But the point is, I did not adhere to my discipline. In this is one of the few times that it worked to my advantage. So I usually wouldn't feel bad about missing an up move like this, because I wouldn't because a lot of times it'll close weak and then maybe gap down to $5 a share, and then I figure I would get exactly what I deserve for holding a stock that closes that week. Anyways, I hope that helps, and there's a lesson in there for you as well. I don't own any more of this stock. It kind of failed miserably in my opinion today, holding below that volume weighted average price for most of the session. Anyway, that'll do it. Have a good weekend. Thanks for tuning in.